Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
So, Eric, it's August. We've been desperate to find guests to join us on the podcast. And then somebody got a new job, Dave Nadig, and we were like, you know what? He's going to go to ETF.com. We should bring the competition on the podcast, let him promote himself a little bit, kick some themes around. Also get somebody who works for you, who can't say no, Athanasios Psarofagis, and basically we'll run through some headlines. How's that sound?
That sounds good to me.
Okay, so I gave it all away already, but we're going to have Athanasios Psarofagis of Bloomberg Intelligence and Dave Nadig, who's now the president and director of research of ETF.com, a site that no doubt he's going to tell us all about because he's been there for multiple jobs through the years. But Eric, the biggest thing is that there's been a ton of interesting headlines about ETFs of late.
Yeah, Bloomberg News has been on fire, and not to pat ourselves on the back, but so is BI. And there's a lot of things to just go through. So we had all these ideas for topics, but there's no way they would take 3 months to do separately. So we're going to cram a lot of the recent news activity into sort of one of our McLaughlin Group type episodes where we, or maybe a ESPN First Take would be a more modern example, but where we just roundtable these things. And just real quick, Joel, I gotta say something. I think we've been doing this for like 10 years. ETFs this year are on pace to take in $1 trillion for the second year in a row. And I put out on X earlier that the name of this podcast has aged very well. So good job. You picked it. I wanted to call it Beta Males, and I'm glad we went with Trillions.
Yep, I will take credit for that. This time on Trillions, Roundtable. Athanasios, Dave, welcome back to Trillions.
Thanks for having me.
Thanks. Even though I couldn't say no, glad to be back.
That's true.
Dave, congrats on the new role.
Thank you very much. It does feel a little bit like a return. I left as CEO and I'm back as president. So, nothing changes but stays the same.
Is that better or different or what? Yeah, like what should we expect from you?
The better is that the new CEO is Matt Middleton, who you may know from running the Future Proof conference series, who really knows what he's doing when it comes to making big events that move the needle. And that's what we're going to do. We're going to do a lot of multimedia content. We're going to build content around ETFs people can trust, like some people may be around this table. And we're going to put on a big event. That's what we're going to do. It's going to be fun.
Yeah, Joel, let me just chime in here because, one of the reasons I got excited about ETFs was Dave Nadig and Matt Hogan had a podcast when they were on Index, when they called it Index Universe, which was later named ETF.com. So Dave, honestly, this is like 20 years ago, founded this website, and then they went to ETF.com, and then people started to slowly disperse, and they went to ETF issuers, other media companies, crypto, you name it. And ETF.com, carried on, but, there's some good stories now and then, but it's not nearly the magnet it was. And so to me, this is like Steve Jobs returning to Apple, maybe on a smaller scale, but similar situation here. So the pressure is on Dave to come up with the iPod, the iPhone. His third act better be good.
No pressure.
I'll do my best. But look, the ETF industry has changed. I think the URL that is ETF.com can mean something different now than it did 20 years ago, right? I think we've got, and we're going to talk about it, we've got over 4,600 ETFs now. Back then we had 450. It's a different world, so we'll make a different website.
All right, so we've got a handful of themes that we're going to talk about. The first one that I want to start with is a headline from Vildana Heinrich that really made me sit up. New this week. There are now more ETFs in the United States than there are individual stocks. So the number that she has in the story, there are 4,300 exchange-traded funds versus 4,200 stocks. Ethan.
Yeah, I mean, I guess...
Over to you. What do you think of that?
It's, definitely mind-blowing. But I guess it was, if you just kind of look at the nature of the stuff that's being brought out now. So, it's a lot of single stock stuff. So you have, Tesla. Then you have so many ETFs like long Tesla, then short Tesla, then option income Tesla. So on one ticker, you have like 20 ETFs that are being launched. So I guess it probably would have happened eventually, but it's definitely is a really surprising stat that there are more ETFs than stocks. And maybe the bigger problem is we just don't have enough stocks, right? Maybe that's a whole nother debate, but like there's so few stocks and so many products being launched off of like a very, tight list.
Just real quick on that, you had a piece out, a note about ETFs being the new IPO, and the exchange is really just trying to get ETFs now more than companies to list.
Yeah, we looked at that, and I think, if you look, there's not a lot of IPOs anymore, right? And you look at something like, I hate to admit it, but like IBIT, right? That is worth more to NASDAQ than like an IPO. It trades more than a lot of new IPOs. So I get why the exchanges, they're backing like the share class ruling and things like that. Like if there's not IPOs coming, the ETFs are just as good. So and just given how much, the percentage of trading that's going up in ETFs, I get that they want to really lean into this and sort of fill that gap for the drought on IPOs.
Yeah, I'd add a couple things there. One, you're right, there are not enough companies IPOing, so that's a whole problem by itself that has nothing to do with ETFs. That's just how we structure the capital markets right now. So all the interesting capital formation actually happens privately, and then when things are big enough, they IPO straight into indexes, right? That's the pattern that we've seen over and over. But I'm not sure that I'd be a lot of hand wavy about the fact that there are now more ETFs. Like I think Sam Rowe made the comment this morning on Twitter, there are also more recipes than there are ingredients. And I think that's also true. Look, we have 150,000 indexes tracked by the Index Industry Association. Obviously, that's insane, but you just add one stock, get rid of another, and now you have a brand new index, right? So, of course, we're going to end up with that proliferation. I think there are issues, right? It makes figuring out what ETF to buy a lot harder than it was 20 years ago, as we were saying.
Yeah.
Actually, I find that to be like this prevailing problem just in my life in general. Like I call it the bread aisle, as my wife would test. It's like you get in the bread aisle and it's like, how am I supposed to make a decision? All of these things are basically the same.
Yeah, isn't that
And
called?
then you end
There's
up
a
reading
term
the
for that.
ingredients closely.
The
Yeah.
paradox
Well,
of
it's-
choice. I
yes,
think that's the term
exactly.
for it. So I agree. It's just the way it goes. When something's successful, and especially in asset management, if the fish are biting in a certain lake, they're going to launch products to try to get bites. So it's a natural part of capitalism. I did look, and there are almost 6,000 mutual funds. So there's been more mutual funds than stocks for 30 years. The ETFs of the 4,000, whatever, 500 there are, half of them are below $100 million. So most of these live in oblivion, and only a couple really catch on. And so I think in my first book, I've used the metaphor of there are, I forget how many notes there are, like 7 notes, and then there's maybe a couple hundred chords, but there's like 100 million songs. Right. Or as Meb Faber puts it, there's definitely more words than letters. So
Right.
I don't care. I think it's just a sign of the industry growing, but I agree. It is harder and harder to make a choice. I think that gives all of us here some job security, which is good.
It's going to get so much worse too. Between the single stock stuff that you were pointing out, there's going to be 7 to 20 ETFs for every single ticker at some point. And we've got the share class conversions coming down the pipe, which could be anywhere from 0 to a couple thousand new ETFs, depending on how aggressive that industry wants to get.
Yeah. I mean, Dave Nadig, where do you think we end up? Like, if you had to pick a plateau number, what would you pick?
8,000.
Okay. How about you?
Right. I mean, if you figure every stock in the S&P 500 is going to have a few varieties, right? At least a leveraged, at least a covered call strategy, probably a short. So there's probably 2,000 to 3,000 ETFs just on the single stock, degen shenanigan side. And then the 4,000 we've already got, and another 1,000 or 2 that are going to show up because people want to, do the share class spoking in thing.
Yeah.
8,000.
We last time we had you on, we had that note that we wrote earlier in the year. No industry for old analysts, because Dave, you and Athan are very similar. That when there's one of these crazy single stock covered call yield max that launches, that especially if they combine 2 or 3 things, like now there's a 2x buffer stock
Yeah,
ETF.
Ethan and I just lose our minds. Like, we turn into little blithering idiots with drool running out of our mouths. I understand.
Ethan puts the picture of Tommy Lee Jones looking over the paper in No Country for Old Men. Like, what? Anyway, I get it. I'm probably the most liberal of you guys because I just find the trading wing of the ETF tent okay. Given that there are plenty of ways to gamble, this is America. It's it's just, I think I just look at the ETF as a technology, not as an index fund. And I think that's where I might be more liberal.
I think you and I agree more than we disagree on this. I'm not anti people trading these vehicles to, run their cowboy accounts or hedge funds using them to run their exposures, but they're good and bad ones of those too, right? That's really, I think, the key thing is that there are good single stock leverage funds and there are bad single stock leverage funds. And it tends to have to do with things like how much got buried in the swap contract you're not paying attention to. How much do these things actually cost? Do they trade at 2% spreads on high vol days? Like, there are good and bad ones, even in the hottest of hot sauce.
And I would argue there are good and bad ones, even in the most vanilla areas. Yeah.
Yeah, there's the wrong S&P 500 ETF to buy.
Which one is that, Dave?
The one that costs too much. Probably SPY. Honestly,
I will say,
it's SPY.
Yeah, it probably is SPY. In the mutual fund world, the second ever index mutual fund is Wells Fargo, and that still charges like 35, 40 bips.
There's still a 2% S&P mutual fund trading. Yeah. It's got hundreds of millions of dollars in it. Like, it should be illegal by design. I don't know.
Okay, whatever. Topic number 2. This is a headline, a note from James Seifert at Bloomberg Intelligence. Headline: passive ownership is rising and more complex than meets the eye. Dave, is that true?
Yes, both of those things are true. You guys track the passive stuff better than most people. I mean, what are you at? 35% measurable, 50% probable, something like that?
Well,
it's a lot.
Let's just define passive. In James's note, he says the average stock has 20% of its shares owned by passive, which is defined, by the way, as index something, ETF or mutual fund, which can include smart beta. So it's a pretty wide array.
Yeah, but that misses it. The problem with that
the
data
institutional,
is
separate accounts and CITs.
Separate accounts.
So where should we go? 20 to what? 30?
I would say 35.
35. Okay, let's say it's 35.
The academic research points
to
the 35-40 range.
Fair. So your take is, should we worry?
So my take is, yes, it matters, but for not for the reasons everybody thinks it does. It's too complicated to be a blanket good or bad. What really matters is the flow in and out of these big block products. It actually doesn't matter whether they're quote unquote indexed, but if you build a giant block trade based on cap weighting, that has real impacts on price discovery because the elasticity of big stocks is different than elasticity of small stocks. So you end up with this kind of runaway winner, runaway loser problem at the top of the cap table, which we see every week when we get allocations into TDFs and the 401k money flowing in, all of which can turn around. Everybody could decide to pull all their money out of their target date funds and buy cash tomorrow, right? So sentiment overrules all of this. But until you see some of those numbers change, the constant drumbeat of money flowing through passive into the market does disturb price discovery. And there's been some amazing deep academic research in the last 18 months on this that's pretty difficult to argue with. I mean, it's not foo-foo ideas. It's like, no, we looked at millions of data points over 20 years and you can kind of prove it. Things like Bitcoin are great sort of petri dishes for this because, absolutely limited supply flow is the only thing that changes price. It's kind of proved all our points.
Well, I get that. And obviously, if a bunch of money is going in and buying VU and VU-like products, it's going to push the prices up. That's a fact. But the VU weightings are totally determined by active. Because, Athanasios, I'll turn to you on this. He did a deep dive and found that, when Tesla has a bad earnings, it sells off. Its market cap goes down. NVIDIA was the 150th stock in the S&P only like 5 years ago. And its index didn't do that. Active likes NVIDIA, and it hates Macy's, which got kicked out of the S&P. So
for sure,
yeah.
But I'm not saying that that's the reason NVIDIA rockets to the top. I'm saying it's the reason that the market in general becomes slowly more top-heavy because the incremental dollar goes into a stock like NVIDIA, which is much less elastic than Public Storage Inc., right? So Public Storage Inc., anybody can swap that out for another industrial. Nobody cares. If you don't have NVIDIA in your portfolio, you have a problem as an active manager. So for that reason, a dollar going into NVIDIA moves NVIDIA more than a dollar going into a company at the bottom of the cap table. And that's math. We can prove that. That's just actually what's happened. So yes, price discovery still happens, but it actually happens violently with a smaller number of players, which rockets things either up or down. And then the next thing that comes in reinforces that, either up or down.
I think you brought up a good point. And honestly, I don't want to cop out. I don't think anyone knows. I've seen good research on both sides. I get that the system is structurally set up that, yeah, flows are going to come in. It's going to keep going to these stocks. I'm not fully convinced that it's like a problem yet. I think there's still too many like holes you can poke in it.
I don't think anybody should do anything about it. Like, I don't think the answer is don't buy passive. I think that this actually means, for the love of God, stay in cap-weighted products and stay invested, because these are tailwinds to the market. They can whipsaw, but I actually can't point to the thing that's going to make it whipsaw. It's not old people retiring. That's not going to do it. That's actually going to help, because all those young people who inherit it buy more, right? So I don't think this means you do something different. I think it explains what we've been witnessing for the last 10 years.
Yeah. I would also just say that one thing that may change this, and probably it's also good for everybody, is that active is getting cheaper. And so the more that the capital groups and Fidelities and T. Rowe's lower their fees, the more they see organic flows. I think advisors do want active. They just want to pay us a lighter fee for it. And that would obviously introduce more price discovery based on fundamentals, because those active funds do hold different stocks with different weightings. So in a way, and we debate this with Mike Green from Simplify all the time, one of the things that is just an inconvenient truth here is that active managers were caught in a very disruptible position, charging a 1% for mostly beta, and Vanguard disrupted the crap out of them. They never passed on economies of scale during the 50 years they had a chance to. And if they had, they'd have more outperformance, more customer goodwill. But because they didn't, I find that sin is still haunting them. But as they adapt, as they adapt, though, and money shifts back to active, because active's taken in 25% of the flows this year, some of this will possibly be sorted out by the market.
Yeah, and look, we've got folks like Barron coming in. I mean, the thing that's shocking to me is that we've got classes of active managers that have been crushing it for 1, 3, 5, 10, 20, like Barron, like Bridgehaven. Like, there's a bunch of active managers you can look at and be like, no, they've done everything they said they were going to do, and they're crushing, and they all have outflows. Like, it's bananas.
The Barron guy coming into ETFs is capitulation. I bet he didn't want to. But Joel, this is the only guy in 15 years to beat the Qs. Beating the Qs is like, it's like beating Michael Jordan in his prime. Like, how did you do that, right? And it brings me, I always think of that quote from the Tim Burton Batman. Remember when Michael Keaton's like, oh, you want to get nuts? Let's get nuts.
Yeah, like 30% Tesla. Let's go.
You got to get more crazy than the Qs. And he did.
Oh, and he did.
It's like half the mutual fund is Elon Musk companies. It's like SpaceX and Tesla. So that's part of, I think, what worked is discarding the CFA brain and getting a little crazy. And Barron did it. Now he's coming into ETFs. We'll see what happens. Like, the timing is interesting. Would this be a signal that maybe now is the time that he underperforms? I don't know. But also, he's coming in at 1%. I think that's a pretty hefty fee.
Did we get it? Did we get an actual fee? I didn't see that.
That's what Katie Greifeld reported. I think it was like one of them was 70 bips, one was 1%. Either way, those are all. That said, if he has active share of like 95 or % or
which
above,
they do.
Then it's in this sort of ARC thematic bucket. People pay more. People have less price sensitivity for stuff that has high active share.
Even a 1%, it's a bargain compared to like the A. Some of his mutual fund share classes are 1.9.
Yeah.
So like, there's some real dang expensive stuff out there.
Yeah, and like, by the way, Tom Lee also had great success with Granny, the Granny Shots ETF. Now he's launching 2 new ones. Dan Ives have come in. So it's not just that big old school managers are getting cheaper. You've got these stars. You know, I say, one of our themes is ETFs go Hollywood. Some of these star managers are coming in, and I'm going to say it right now on this show, I believe Bill Ackman will launch an ETF at some point. I don't think Buffett will. I think Berkshire's kind of that for him. But I do think if you are in this industry and you want to be where the fish are biting, you kind of have to come into ETFs now, especially Tom Lee in particular. Seeing the success he's had, $2 billion in less than a year is pretty good. And his fee isn't cheap either. So that's a good sign, I think, for active and maybe the people who are worried about passive growing so much.
Okay, next topic. Eric, this one's going to put you in the hot seat. Magnificent Seven, question mark, was the beginning of a note, the headline for a note that you wrote. Think of them more as the Magnificent 70. Okay, I'm really interested in this because you can't talk about markets without talking about AI and the Magnificent Seven right now. There's 493 other companies, except you say maybe that math is off. Maybe there's many more that should be considered Magnificent Seven companies. What's your reasoning?
Yeah. So, and you brought Sam Rowe up earlier. I actually got this idea from him. He talked about the idea that many of these companies are like multiple companies inside of one. And I thought, yeah, he's right. Like it feels right. So I looked at the amount of acquisitions the Mag 7 companies have made, and it's 850. Between the 7 of them. Google and Microsoft are like 250 each.
Yeah.
And here's the thing, like one of Google's acquisition was YouTube. That's one of 250. YouTube would be the 19th biggest stock in America if it were spun off. And so the amount of brand names, actual capital, cash, these companies, I talked to our analyst, Anurag Rana, who covers some of these tech stocks, and he says they're like countries. They're that big. So I almost think you kind of have to throw your CFA brain out a little bit here too. The Mag 7 should be looked at as 70. So if you
isn't this GE? I mean, aren't we just basically talking about Jack Welch era GE, where it's like, are you a finance company? Are you a tech company? Are you a defense contractor?
We're Berkshire.
The answer is yes, we're all of those things.
Yes.
Well, Berkshire I see more as like actually kind of a holding company.
True.
Versus something like Microsoft, which actually integrates these things and like. And I think they are like countries. I mean, Microsoft is also doing things like building water systems. Like, it's crazy.
Buying nuclear power plants.
Yeah. I went back and looked at GE, and I think their total acquisitions, if I don't want to get hate mail if I'm wrong, but I think it was like 65. So it was a lot.
Certainly not this pace.
Wasn't on the same level. But let's just say we consider them to be 70 companies. All of a sudden, their 34% weighting in the S&P isn't that bad. So I guess part of the reason I wrote this was, Athan and I talk about this all the time in the team. I just not into scaring people out of these companies. There's so many people who are like, it's time to rotate. These companies are overvalued. I'm like, yeah, but people said that 200% ago. And these companies kick so much ass that you can't not own them. Like, these are the leaders of the world in what they do. And it just seems crazy to me. This is where I think you never want to go full CFA. You only go half CFA. You know what I mean? If you go full CFA, you will lose and lag and be miserable.
I agree that I think this is a useful framework. I think you're correct in that from an economic perspective, thinking about Microsoft as being a singular company, the same way that John Deere is a singular company is wrong. However, it's a single security. And so from a risk management, market structure, capital flow perspective, MSFT is still a single stock. And when some big whale decides to fat finger an options trade and it gets tanked by 9%, which seems like a ridiculous amount of value to extract from the market, it's because it's still just one stock. There is some danger in having more and more and more economic activity in fewer and fewer tradable tickers. That's a different problem than, are these companies too big and will they be bad economically? So I'm with you on that. I think the AI thing is an interesting use case here because I think you can make the case that the benefits of AI may actually benefit the bottom 250 in the S&P more than the top 250, because that's where the boring low-hanging fruit of like, can we, replace these 3 boring processes in a back office with an AI? I think that's going to happen more there than NVIDIA is going to have blowout earnings for 8 quarters.
Eric, what are those 70 and how do you get exposure to it?
What I'm saying is if you opened up Google, you're going to find YouTube, a cloud company. I mean, I'm talking Google has about 7 to 10 actual legitimate mid or large caps within it.
Yeah, you're buying a conglomerate.
Yeah, you're buying again, like
conglomerate.
Anurag says, a small country. I mean, if you look at the market cap, these would be bigger than most of the countries on Earth. But to Dave's point, I wrote in my note that isn't to say this is not antitrust issue. And that may be a fact. These companies, how big should they get? Should they get broken up? I feel like that's a fine debate to have, because should Google have that much going on inside of it? That's just different to me than index concentration in terms of what you're buying. So it's a very interesting, complicated issue, but I just wanted to get people to look at it, from this alternative way. And I wasn't alone, although he's biased. Dave Mazza from Roundtable, who has the ETF mags, he wrote a piece similar about there being more to it, and the valuations, might be worth it given how many other companies are inside. So I sort of ripped off from both those guys in my note, although none of them mentioned the amount of total acquisitions, which, again, I thought I was going to find like 20 to 30 in each. And I was like, oh my God, 850?
No, a lot of those are really small companies that were part of a tech stack, right?
True,
so like
but a lot are
I know
massive.
companies that got bought because their calendar plugin was great,
No, I hear you.
Like,
But I went into Google. They bought some company I never heard of for $13 billion.
Oh, no, the numbers are ridiculous.
Cloud
People get
stuff,
rich all over the
like there's stuff, I agree. There's small stuff that is bullshit and doesn't count. But there's some big stuff we never even heard of the company.
Like Slack.
Yes. And like Waze, that app, which I use constantly.
Constantly.
I forget which one of them owns that.
Google.
Google owns that now?
Yeah.
Yeah.
I can't even keep up.
Has forever. Okay, next topic. Katie Greifels' headline earlier in August. Vanguard plans for its costliest ETFs yet in active push. Ethan, I want to talk to you. The new number one at Vanguard is 0.40%.
Yeah.
Followed by 0.35%. This is on top of their current costliest ETF, which is 0.3%.
Yeah, I love.
What do you make of this push into active?
They're playing offense now, right? Like we looked at, Vanguard doesn't launch ETFs that often, and so this year I think it's the most they've had in like 10 years. Obviously, they have a new CEO, but we were looking at this last week. I think if BlackRock didn't have the Bitcoin and crypto stuff, Vanguard would only be like 40 billion behind them. So that gap is gonna close. But yeah, I think they're still a large active manager, right? So I guess it kind of makes sense that they're pushing into that.
But they have active in the name now. These are called the Vanguard Wellington Dividend Growth Active ETF. This is like how Vanguard became Fidelity and Fidelity became Vanguard.
Yeah. Well, it's like David alluded to, the ETF.com means different things now, right?
Yeah,
For sure.
it's different world.
This is that whole era is changing. So I love that they're playing offense. They're getting more aggressive on the product front. And it's fine. They've basically given away their ETFs for free for such a long time. Now it looks like they want to charge a little bit more. They're probably still going to be cheaper than a lot of active stuff anyway. So it's still kind of a win-win. But
I'm a huge fan because it feels like I'm a big fan of like bringing your authentic self to work every day. I feel like Vanguard's finally bringing the authentic Vanguard to market because Wellington's been just raking in cash for them for decades. I mean, you talked a little bit about this in your book. The active thing that lives inside the giant passive enterprise. But I think at some point, I don't know whether it was you guys or somebody else did the rundown on how much revenue they actually generate from the active side of the business versus the ETF side of the business before they got any of the active product over, and it was like 4 times as much money that they make off the active products. It's like they're actually huge in that business. So it's about effing time that they show up and bring those products to the ETF market, in my opinion.
2 things on this. One, I agree. Will they have success, though? It's not a guarantee. Normally when Vanguard comes in, you're like, oh, this is just going to take in $1 billion within a couple months. But they're really late here. They ranked 19th in active ETFs. And they're like 1 or 2 in everything. This is a category they're ridiculously low in. And everybody has come in for the past 10 years and vanguarded the category already. So you got JP Morgan, Capital Group, DFA, Avantis. They're all well below 20 basis points, if not 10 in some cases. So Vanguard comes in a little late. We have a note, a recurring theme we talk about, which is the Vanguard effect has outrun Vanguard. And they're actually stepping into a category that's already had the Vanguard effect, ironically, and they're going to suffer from it, I think. I don't see these being that big. And Dave, I'd like to ask you, do you think they'll ever make the Wellington Fund, the one that's 100 years old, the one that Bogle saved like a firstborn child, that balance fund, do you think they'll ever ETFize that? Because it's not in this mix right now.
I'm very skeptical. I'm with you. I don't think these are going to be big money winners for them. I don't think they're going to get a ton of assets. I think it's a service to those people who already know the Wellington brand and are in those mutual funds, generally at a little bit more money. So I think they'll get some transfer money from advisors. I think that's what they'll get. And they may even get some from institutions, because some institutions use those. They have a pretty big business on the active institutional side. So for people who want a liquidity sleeve on a similar strategy, that whole shtick, they'll get some traction. But I absolutely do not think this is their next big thing. Like, there's not going to be hundreds and hundreds and hundreds of billions of dollars in these things. No way.
Maybe you've looked at this, Eric, but let's say if you take out fees, is Vanguard like a good active manager? Like, would you rather, like, say if you were to go active, would you rather want a capital group or a DFA?
Well, hold on. Fees are matter because I actually work with S&P. They ran the numbers. Vanguard's beat rate
is higher. I see.
Than the average company, and it's directly related to fees. And the further out you go, the higher that beat rate gets, because fees matter more 10, 15 years. This is why in my Bogle Effect book, I premise that if the index or index fund was never an invention, if you just pretend we live in a society without indexing, Vanguard would be the biggest active manager 6-7 times over, because they would have brought their fees down. And that's like giving their managers a huge head start in the race, because they have lower hurdle to overcome. And over long stretches of time, all the Vanguard funds would have been on the cover of Forbes and Fortune as the top managers, just because they're cheap, because I call it Bogle metrics instead of sabermetrics. Even Bogle in his books, by the way, he does brag about active a little bit, but he kind of brings the credit back to himself. He's like, yeah, this guy ran this, he did okay, but honestly, I made the fund cheap, and I told him not a lot of trading, and therefore that's why it really outperformed. And so,
he was not a man without ego, in my experience.
So I always think like the Vanguard secret is the cheapness, but with these funds, they're 40. There's a dozen cheaper.
Yeah.
Yeah, although a lot of those funds are really very low turnover, low active share. I mean, like the Avanta stuff, most of the active share on that is measured in, 10, 15%. Like, I mean, it's not a lot compared to something like Ron Perrin coming in with something that's just crazy and wild. I agree. I think these are going to struggle at this price point.
Next topic. Isabella Lee, Bloomberg News reporter, cross assets, often on the show, writes, tokenization boom. Wall Street still isn't biting, JP Morgan says. So this is ultimately about the idea that we're going to see assets go onto the blockchain. JP Morgan says that that's beginning to happen, but really it's 25 billion so far. And that's really being driven by crypto native firms rather than Wall Street incumbents. Dave, have we already reached peak blockchain here?
God, no. I think we're... Mike Philbrick from Resolve posted a thing saying, like, where are we on the comparison to the fiber rollout or the railroads or all of that stuff? And I put up a picture of Stephenson's rocket. Like, I think we are still at the very early innings on both crypto and AI, and I think they are related, unfortunately. But like, we're actually starting to see things like bonds issued on-chain, held on-chain, redeemed on-chain without ever touching secondary systems. That's like very recent. It's really in the last month we've had some of these entirely on-chain but still fully regulated institutional securities issuance and settlement things going on. That's exciting. Like, we should all be excited about that. That's the future. We're going to get rid of DTCC eventually, right? So that, I think, is just starting to kick in. That's part of the, I would call, regulatory halo effect of this administration, is people are now just trying things and figuring they won't get sued into oblivion later. And that's great. I think we're seeing the same thing with like the trial that's going on in New Jersey to take all the real estate records and put all that information on chain so you can do like instantaneous real estate settlement. It's all really cool. So I'm a seller on the idea that somehow that part is peaked. That doesn't mean prices don't come down and Bitcoin could still be worth 50 grand. What the heck do I know? But from a blockchain and real world assets and tokenization perspective, I am very bullish, very, very bullish.
My take on this is if you're younger or in a emerging market and you have a wallet, you have a digital wallet right now, and you've grown up with it, I think tokens of stocks and ETFs will be what you buy, because that's the universe you want to be in. I just don't think that is going to absorb the entire financial ecosystem. I think it will be another avenue, and I think ETFs, especially in developed markets, simply because the customers are just so happy. It's just tough to get people to move, and if they're happy campers. But anyone who's digitally native, the ETF industry and the all the exchanges and whatnot who want to get more money into stocks and ETFs should tokenize this stuff. It's just another way to reach a new audience who's used to this other way to get them, which is a digital wallet. The good thing about that is it does open them up to the whole world. It does open them up 24/7 if that's your thing, although I think that's a little overrated. And so people who don't otherwise have access, which is about half the world, can now easily buy shares of Microsoft or VU or SPY or whatever. So I'm all for it. I just think that half of the world has such a small percentage of the global money that the motive to serve them is less than serving the people who are already happy in low-cost ETFs and whatnot, and even mutual funds. So I just see it as if it does take over, it will be 20 years from now when the wallet people grow up and get all the money inherited. So this is very interesting. I'm evolving on it constantly. I still think Nate Geraci should have kept his name ETF Store, at least for. Do you have any plans to change ETF.com to something else?
I think that would be dumb. I think that would be a dumb idea.
All right. Good job. So I just think, at least for us, we're middle-aged, I would call us, we're probably good covering ETFs until we retire. I think the next generation is going to have to figure out what to call themselves.
Yeah, it'll be a new job title for sure.
I completely agree on the stock and ETF side. The problem is that the way we're talking about doing it right now, even the people who are doing it really well, and I'd probably highlight Wisdom Tree Prime as the folks I think have kind of figured this out the best. Like, have your own wallet, put gold in it, put crypto in it, and then put some tokenized funds in alongside of it. So you kind of create a whole on-app ecosystem. Even that, I think the problem is you're still wrapping Tesla shares. You're still wrapping VU. And if you're wrapping something, you're not actually changing anything. You're adding a layer of complexity and failure to an existing ecosystem that's got pretty good backstops for things like a blown trade or a fat finger. So I think we'll head that direction. But until we get serious about solving the plumbing, like until this comes from the NSCC or the DTCC, it's kind of just fairy tale land.
Remember when they first were talking about like the metaverse, and they were like showing those like kind of like those lame like videos of like you couldn't really see, and that's kind of like how I still see tokenization. Like ETFs are already so frictionless. Like, what are you gonna? How much of the process actually gonna get improved?
Yeah.
Unless
And
Microsoft is launching tokens, like you said, but to buy a token on Microsoft stock, I just don't see the point. So you're adding layers.
Again, it would be for people who don't have access to brokerage accounts but have internet access. Which is the stablecoin argument. So in other words, to me, the token argument is very similar to the stablecoin argument. It's for the same audience, but that's a small percentage of the global money. The other thing that was brought up was, and because of this crypto book I'm working on, we interviewed Jim Bianco, who has been somewhat hesitant of the Bitcoin ETFs, and he said that the more the ETFs get popular, it hurts the Bitcoin case because it keeps people in the regular system as opposed to moving on chain. And that is an interesting point. But I also think that point shows you just how badass the ETFs are and how convenient they are, that people would rather just click buy than go onto this new thing. So the blockchain world also, I think, has a lot of work to do to get the interfaces a little easier, because you've got to make it McDonald's easy to get a wallet and move your money. I've tried it. It's not that easy. There is some friction to it. You can do it, but it's not McDonald's easy yet.
Nobody's going to move. They're just going to get it on their existing platform, right? I, as a Schwab customer, am just going to wake up in a year and I'll be able to do all of this with my Schwab app on my phone without having had to do anything except click OK on another terms of service I didn't read.
Okay, last story that we're going to talk about, last topic. Amazing headline from Bloomberg News. Nuclear weapons pass ESG test as war redefines ethical investing. Whoa, there's a lot to unpack there.
I saw that headline and I was like, this has got Eric all over.
So,
Oh yeah,
So
no,
Dave,
I got giddy.
before
I
we let
tweeted it
Eric
on a
talk-
Sunday night, and I really don't not use Twitter on Sunday nights because I don't want that in my brain when I'm trying to get the most important night's sleep. But I couldn't resist.
Okay, here's the lead, Dave, and I'll let you take it from here. The deadliest weapons ever manufactured are becoming a regular feature of Europe's nearly $9 trillion ESG fund industry. How does that make you feel?
Well, look, Eric and I have debated ESG many times in many forums over the years, and I've always been a little bit more pro, and Eric's always been a little bit more skeptical. So I was reading this, and I was like, okay, Eric, I can't wait to read Eric's crow about this. Look, I think where we probably agree is trying to one-size-fits-all something like a values-based investment system just doesn't actually work. And I think we've mostly agreed on that part for a long time. I do think it's very easy to say, nobody cares about ESG and it's all a scam. And I would point out that we just had $250 billion issued in green bonds that are all certified and going to climate projects in the first quarter of this year. So we got $1 trillion a year in new security issuance that is the most woke green stuff you can imagine. So to say it's a dead industry would deny the fact that it's actually the hottest part of the bond issuance market. That has nothing to do with ETFs owning a bunch of equities. And I think for most people, if they've got real wealth, whether they're a sovereign wealth fund or just a millionaire, you're better off in a DI or a separately managed account type process, because then you can say, okay, it's a little ridiculous. I don't want to buy nuclear weapons in my ESG fund. Or maybe you say, hey, you know what I'm really doing is I'm voting based on my political ethos. And yeah, right now I do want to do that. But I don't think you can package that up into some like MSCI index and say, this is for everybody. I think that's ridiculous.
I agree. This was taking something that was subjective, even between index makers, let alone people and investors, and making it objective. What is good? Is a nuclear weapon good if you're taking out a bad guy? Well, yeah. Well then isn't the fossil fuel good that supplies that nuclear weapon, or the tanks that you're going to get the bad guys? What about the smokes the soldiers need, or the alcohol they need to drink after they have trauma? Like, if you want to go down the line, nothing is ESG or everything is ESG. You can take this to a place where I think you throw your hands up and go, screw it. I'm just going to buy the S&P 500. The reason I have some touchdown dance with this is that the problem I had with ESG wasn't that it existed. It should have just pitched itself as another form of active. Hey, we're going to pick stocks based on this stuff. We may or may not perform. I'd have no problem with that. The problem was it was sort of pitched, and the media has a lot to blame for this, as like this new thing that was going to take over. It was going to make everybody feel good. It was the wave of the future, and it was all got your morals mixed up in it. And the European government in particular, they've really pushed people into ESG. And the problem with getting all virtue signally out there is that at some point you're going to be a hypocrite. Now Europe wants to build up its defense industries because it's not NATO is uncertain, and it has Russia right next to it. And so the war in Ukraine has made Europe into defense. But the people that they want the money from are like, wait, we can't buy those stocks because they're not ESG. You told us that we have to be ESG. And then Europe's like, no, wait. It's okay now because we're fighting Russians. It's just like, I just think that once you get on your moral high horse, you're destined to fall. And I just say, don't get on the moral high horse. Just say that these are new metrics to track companies. This fund is going to pick based on them. Look at the holdings. You may or may not perform. I'm fine with that sales pitch, but I think ESG got hijacked by this morality issue. And I think part of it was because people who normally would vote for these things, if their party isn't in power, they feel like powerless. So they applied a lot of that wanting power to the corporate world. And I just think this isn't the right avenue. Like, an index fund is not the right avenue to fix some of these problems, in my opinion. I think the other, locally and in your government, you need completely new rules around types of energy and all this stuff. So I just find that the other thing is that Dave mentioned is the bonds. Also, bonds are a better way to be ESG, in my opinion, because if you're getting more money from bonds that are green, that's directly going to impact your financial situation. If your stock happens to be sold by an ESG fund and then bought by a value investor, it doesn't really matter. It's just the stock trading on the secondary market, indifferent than your operations. So I will say just a couple things. Bonds are the better way to be ESG if you're going to do it. Locally, even better. Voting, even better. And then if you're going to invest, just know that this is an active strategy that will underperform and outperform, and you better be prepared for that. And that's all we're saying.
Yep, I think we agree. I think it's an active management decision that people make. And hey, sometimes it works out. DSI, which is the oldest ETF we've got in the space, actually has beaten the S&P since inception by a couple percent. So you can't say it's a horrible, horrible idea, but it's absolutely an active bet. And in general, I think most people are better off leaving their politics out of their brokerage account. I'm pretty vocal about the stuff I believe in, and I don't buy ESG products. I just invest in a very, very boring way because it seems to work.
Rick Ferry is like, just buy a cheap index fund, use the money you would have spent on the ESG fund and take that cash and do it something.
Donate it to No Kids Hungry or something.
Yeah, there you go.
100%.
All right, we're going to leave it there. Athanasios, Dave, thanks for joining us on Trillions. Dave, congrats on the new gig.
Thank you.
Thanks for having me on.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. Hit us up on social. I'm at Joel Weber Show. He's at Eric Balchunas. Trillions is produced by Magnus Henriksen. Brendan Newman is our executive producer. Sage Bauman is the head of Bloomberg Podcasts.